Okay, awesome. Thanks. Hello, everyone. My name is Andreas. I'm head of product at Wildcat, and today we're going to talk a little bit about credit, under-collateralized credit, why it's important, the history of credit, and what we do at Wildcat to provide under-collateralized credit to Ethereum. So if you look into the overall history of money, credit has been something that has been overall in all of the eras. We see Knights Templar in the 1200s, where basically the pilgrims, not the pilgrims, but the people were wandering all over Europe had to either travel with a lot of gold in their pockets, or they could choose to use IOUs that were issued, which is pretty much similar to what we have today in the bank industry, where I have money in my bank account, but essentially it's not real money, it's just the promise that I get money from my bank. And we also have concepts like Bank of Japan doing their 2 decades of cheap credit, but basically having no growth. And overall, this basically shows that credit is not everything. You also have to design it in a way that it is interesting for people to use. So let's talk about how credit expands the money supply. We have different types of money. And the most common use of money that we have in nowadays is debit money, so the money that you do have in your bank accounts, which is basically created by the banks themselves in a form of under-collateralized credit, also known as fractional reserve banking, where they can have a deposit and then they have the possibility to make a lot more money with your deposit by using money multiplier, and always backed with the hope that if you go to the bank and you want to draw money, that the bank actually has enough central bank money to give you the money that you should own in a way, and the bank should be able to give to you. This is overall something that is being used in all modern world, but that's also one of the reasons why I think we all are here, because cryptocurrencies go a little bit against the concept of credit-based money, where they basically say the fractional reserve banking and credit implosion, etc., is something that we want to try to eliminate through the concept of cryptocurrencies. The reason why unsecured credit is still so important for us is because there is not enough value generally to fulfill the need of capital in the markets. So to fuel innovation, to let industries grow, there needs to be the concept of unsecured and under-collateralized credit, just because there is no other model that works as good as fractional reserve banking. So with all its bad concepts of fractional reserve banking, it still is kind of the best concept that we have up to today, even though it does have its problem in itself. Regulators try to solve these problems by laws or by securities. So if you, for example, have up to 100,000 in your bank account and the bank goes into default, the regulator or the state basically still fulfills the claim that you cannot lose that you cannot lose anything below 100,000 euros. So that's kind of security in a way that for normal people, for retail, for the day-to-day average person, that is sufficient. But then if we scale up to bigger companies, there's still always the risk that they might lose money if banks go bust. In crypto, especially because we have a lot of price change, we have been introduced to stablecoins. And stablecoins kind of help the whole concept of bringing unsecured and under-collateralized credit on-chain, because they represent actually a true value that we have in the real world. They either represent a euro or they represent a dollar. The problem is that they don't solve the problem of scaling. So stablecoins are typically not the same, or they are not the same as the money that you have in the bank, because where in the bank the money that you have is covered kind of by a promise by the bank that they will repay you the money. Stablecoins are covered with more secure, like treasury bonds, etc. So even though we now have an instrument or a tool on-chain that kind of mimics the way we do payment in the traditional financial world, it still won't bring us to the volume of money that we need to compete with the TradeFi space or to make crypto a valid alternative to the TradeFi space. The good part is that credit and Mika is very relaxed, especially if you look at DeFi protocols, because lending and borrowing is not within Mika, and stablecoins are not considered to be money, even though they kind of mimic money. But overall, that's something that we can actually leverage to our advantage for the next couple of years until they find a way to close that gap, or hopefully not. We can actually create money markets on-chain that mimic even the way that underclass credit is being done in the real world with stablecoins. So since we're talking about Wildcat, since we're talking about underclass credits, and since I am from Wildcat, just a brief history of what actually Wildcat banking is. So back in the Wild Wild West era, where they didn't have any central banks, and you had to travel a long distance to reach cities, everything was very remote. You had big companies, typically railroad companies that deposited or let people deposit their gold with them, and for that they printed money to them that they could basically use. And all of that was secured, but it also was under-collateralized in a way that typically those banks gave out more money that they actually have reserves. But for that area, that was very, in a way, positive because it did fuel overall the innovation that we had there, and it was supporting the whole gold rush and the gold boom that there was. The problem was that even though they did provide the accessibility to credit and they did foster the financial innovation there, they did eventually go bust, and there were a lot of problems just because the transparency behind those Wildcat banks was not there, and also everything was very delayed. So since my Wildcat bank or my nearest Wildcat bank might have been like 2 to 3 days on a horseback, I didn't know if that bank actually still existed. So at the time where I then wanted to go to my bank and pay something or get some more money or deposit something, I ended up in the city and the bank was closed because basically they went into default. So a lack of transparency, but also a lack of information speed was basically the downfall of Wildcat banks, which then resulted in actual central bank money concepts in the States and more regulated entities being able to print money and create money in the States. So if we look at the overall concept, the overall tools that we have in crypto, we have great technology, we have great assets, but we're still kind of struggling to compete with the TradeFi space. And of course, people don't necessarily want to compete with the TradeFi space, but at least we want to have some valid alternative to the TradeFi space. I always explain it in a way that if I go shopping, I love to pay with banknotes, but I also love to pay with my Gnosis Pay credit card. I just like to have the alternative that I can choose what I want to pay with. And it's the same for me with crypto. In my opinion, crypto should be a valid alternative to fiat, but currently it is not. And the reason is why it is not, or like what happens if it is, we do see phases where credit mimics the traditional financial world, and then it results in huge systematic problems. If you look at the last private credit era, where we had the problems with FTX, etc., it was like a huge problem because nobody knew what was actually going on. So we did have underclass credit on-chain, in a way that it was very intransparent. We had private credit, which was very, in a way, successful, but it failed very fast because nobody knew what was actually going on. Nobody knew that these companies are in default or that they're losing money or that they don't have the monies that they actually claim to have. And the reason why this was is because, or one of the reasons was because everything that they were doing wasn't actually recorded on-chain. They were using Telegram, Google Sheets, Excel to track all of this and just use Ethereum or any other blockchain as a settlement layer to actually transfer the asset, but there was no actually insight. If you look at or compete or compare the two worlds, we have cryptocurrencies and we have the overall credit market of the world. Like crypto in everything, like Bitcoin, Ethereum, all of the stable coins, and all of the other tokens that are seen on CoinMarketCap, it's almost like 1% of the credit market. And that's one of the reasons why I say that even though crypto is fun and crypto is growing, it's still not a valid alternative to the TradeFi space because the gap is just so huge. So the question is, how can we close the gap? We want to provide an alternative to TradeFi, but we're not using the most powerful tool that TradeFi has, which is fractional reserve banking. And if we look at fractional reserve concepts or under-collateralized credit concepts that are currently existing, they have huge problems. They're very overcomplicated. They're mostly not very transparent. You mostly have one central entity in charge of distributing the loans that lenders are able to pay. And that just does not give the trust or the transparency that we need to scale to the 300 trillion that we actually need. That's why meet Wildcat. That's basically what we've been working on the last 1.5 years. It's a protocol where borrowers can broadcast their desires to potential lenders and get credit either fully collateralized or under-collateralized or non-collateralized. We let borrowers basically present themselves and dictate or present the terms that they want to lend. We allow them to create markets in any ERC20 token. We allow them to define what APR they want to pay. We let them define what withdrawal cycles they have. We let them define what people they want to get money from, if it's an open access, if it's a closed access. In general, everything that a borrower needs to present themselves, we're trying to offer them so that it makes them interesting for lenders to deposit. That will allow, or that allows, basically, any under-collateralized credit that is being done on Wildcat to be as easy as a swap or a token sale or just a normal transfer. The idea is that we want to be a credit layer. We want Wildcat to be able to facilitate all types of credits, open-term credits, fixed-term credits. We're working on credit concepts where DAOs can back their under-collateralized credit lines with native tokens so that if DAOs have a liquidity need, they don't have to liquidate their DAO token, which would result in a price decrease. We want to actually allow them to just back it, and if there is a default and they cannot pay it back, then there is a liquidation. We've been live since 1.5 years, but we launched V2 in February 2025 with about 120 million in TVL currently. The long-term goal of Wildcat is to create this borrower-issued debt token, which kind of represents the true DeFi banking, where, for example, if we have Wintermute being on Wildcat as a borrower and accepting assets and paying 11% in APR, that the debt that is created there can actually be reused by the lenders to deposit that into Aave, to deposit that into Euler, or to even use it on other exchanges as collateral to basically do OTC margin calls, etc. And that kind of fosters the multiplication effect that we have in the TradeFi space by making more money out of only a little bit amount of money. Small team, questions? Yes, I can literally almost not see anything because of the lights are so bright, which is also good because...
Here you go. Thank you very much for the interesting talk. Biggest question I have is, how do you do the enforcement if a borrower does not pay back?
Yes. Good baseball bat is the easiest. No. So we are in charge of just making it possible that the borrower can present themselves. We are not in charge. We don't underwrite the credit. We don't do any credit scoring. We don't give like any opinion. We're very objectively. So if the lender is convinced that the borrower basically will not repay, then don't put money into that market. But if you think that they will repay, put money into the market. The overall advantage that we have is the gain of transparency. So the markets do have different types of health indicators. So there's healthy market, then there's like a delinquent market, and then there's penalty market. And depending on what state the market is, it makes it more interesting or less interesting for a potential new lender to invest into that market. So if the market is healthy, the lender can basically look at the market. They can see how much credit has flown into the market, how much credit has flown out of the market. Is it just like a fixed-term market where I can invest and then in 2 years I get my money back? Is the market in a delinquent state, and then understanding the reason why it is in a delinquent state? It just gives more transparency of the actual market state. But we do provide information about the borrower, so we do onboard the borrowers with a KYB process, where we make sure that if you see a name of a legal entity, that it actually represents the legal entity. So that if something happens, you could also take a lawyer and sue if there's a default. That's the worst case scenario. Now, the question is not if that will happen, the question is when that will happen, and then what the market basically does with that information.
Other questions for Andreas? Right here.
Yeah, thanks for the presentation. Like, are there any minimum standards that basically you apply for like these borrowers to basically next to be KYC to kind of like disclose, or if not, is there like any tools that you provide for the borrower to kind of like disclose their financial statements if they're a company, or spending behavior, or any kind of, or is there like basically mostly blank and you need to rely on whether they have repaid prior loans and you're like can actually like derive something from it? Because if they are taking the first loan, right, being performant, like if they pay back the first time in 2 years, is like not really telling you anything then.
That's true. So we don't look at like the business model of the company, and we also don't like necessarily about the pure details of the financials, etc. But we do look at the company itself and try to make sure that it is a company that is actually there and that hasn't been like created a month before and just wants to like deploy market and then grab money and then run away. The current results currently, like with 11 borrowers, you can see that the lenders are doing what is expected. They are depositing money into markets that either have been created by big companies that are well known in the industry, or if they're not super known in the industry, they do provide like a very high APR that it is interesting for people to like put a little bit money into. Like you wouldn't put 100% of your money into a under-collateralized market of a company that you don't know, just because you need to have like a little bit diversification of your assets. So that's like the security that we provide in terms of, we make sure that the company is who the company is, but we're not objective of the business case. In terms of the transparency, the financial statements, at some overall like future time, we want to add more and more features for the borrowers to present themselves as best as they can. It's like we jokingly say it's like Wildcat is like the Tinder for private credit, where you like present yourself and try to get the matches, and then you have to like be attractive for the lender. So like we have to figure out what is actually making borrowers attractive to the lenders. If that is adding more, possibilities to have like a profile with more descriptions, or upload documents that have a proof record, or connected to real-world asset oracles that basically query and provide data about reserves that are held in banks, etc. All of that is in the scope and in the shaping.
Other questions for Andreas? All right, if not, we'll wrap it up there. Thank you so much for Andreas.